Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Easterly Government Properties, Inc. Annual Report. Easterly Government Properties, Inc. specializes in acquiring, developing, and managing high-quality commercial properties that are leased to the U.S. government. The company's expertise lies in understanding the needs of mission-critical government agencies, allowing them to provide tailored solutions for these entities. The company provides a range of services and businesses, including property acquisition and development, management of Class A commercial properties, and leasing to the U.S. government directly or through the General Services Administration, GSA. This comprehensive approach enables Easterly Government Properties, Inc. to cater to the diverse needs of government agencies, making them a trusted partner in the industry. By focusing on the specific requirements of government agencies, Easterly Government Properties, Inc. has established itself as a leader in providing high-quality commercial properties that meet the unique needs of these entities. The company's commitment to understanding and addressing the needs of its clients has enabled it to build strong relationships with government agencies and establish a reputation for excellence in the industry. The services provided by Easterly Government Properties, Inc. include property acquisition and development management of Class A commercial properties leasing to the U.S. government directly or through the GSA. These services are designed to meet the specific needs of government agencies, making Easterly Government Properties, Inc. a trusted partner in the industry. Easterly Government Properties, Inc.'s DEA stock price experienced a significant drop of over -10.51% in April 2025. This decline was triggered by the company's announcement of a reduction in its quarterly dividend and a 1-for-2.5 reverse stock split. The key factor contributing to the stock price drop was the decrease in dividend payout, which fell by approximately 32%. The board of directors had approved this cut to align with industry best practices and generate capital for growth opportunities. However, investors likely perceived this move as negative, leading to a sharp depreciation in the stock price. The reverse stock split, effective April 28, 2025, mechanically adjusted the share price upwards, but did not mitigate the impact of the dividend reduction on investor sentiment. As a result, the company's stock price fell from $9.52 to $8.23, representing a 13.55% decrease. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth and decline are multifaceted and influenced by various market and economic conditions. On the growth side, key factors include rental income from new operating properties, tenant improvement services, non-customary services provided to tenants, and receipt of rent payments from government agencies. Additionally, the ability to renew expiring leases, location of additional properties, capital expenditures to improve properties, and successful integration of acquired properties are also significant drivers. Furthermore, access to capital at favorable terms, collection of balances due from private tenants, tenant retention and attraction, and competition for acquisitions and dispositions all contribute to revenue growth. On the other hand, unfavorable market and economic conditions, occupancy levels, rental rates, and rent collections are primary drivers of revenue decline. Operating expenses, market value of assets, U.S. government tenant agency missions and workforce changes, and lease renewal opportunities also negatively impact revenue. Natural disasters, climate change, and extreme weather events pose significant risks to revenue growth, as do pandemics, epidemics, or outbreaks of highly infectious diseases. Changes in federal and state legislation and regulation on climate change, condemnation proceedings by government agencies, and inclement winter weather on the Atlantic coast are also potential drivers of revenue decline. The net income of the company decreased significantly in 2025 compared to the previous year. The net income dropped by $7 million to $13.6 million, a decrease of $220.9 million from $252.9 million in 2024. This decline can be attributed to potential losses from natural disasters and climate change, which have become a major concern for the company. The profit margins of the company may also face a decrease due to increased costs associated with climate change regulations and potential condemnation proceedings. Higher interest rates could lead to reduced income, insufficient cash for distributions, and limited recourse against sellers of acquired properties. These factors contribute to the uncertainty surrounding the company's financial performance in 2025. The reasons behind the net income decrease are multifaceted. In addition to natural disasters and climate change, the company is also concerned about uncertainty in future credit losses, impairment charges for properties, unknown or contingent liabilities related to acquired properties, and potential need to borrow funds or dispose of assets to meet distribution requirements. These factors have created a challenging environment for the company's financial performance. Overall, the decline in net income and potential decrease in profit margins are significant concerns for the company. The impact of climate change and natural disasters on the company's financial performance is evident, and it remains to be seen how the company will navigate these challenges in the future. The company's financial performance suggests a positive trend in its operating cash flow. According to the summary on page 53, the company generated $96,559 more in operating cash flow in 2025 compared to 2024. This increase is evident from the comparison of operating activities between the 2 years, with $259,194 in 2025 and $162,635 in 2024. The data indicates a significant improvement in the company's ability to generate positive operating cash flow, which is a crucial indicator of its financial health. The company's debt level has remained relatively stable over the past few years, with total indebtedness ranging between $1.7 billion and $2.01 billion. However, a closer look at the data reveals that there is a slight increase in total debt from $1.666 million to $2.01 billion between 2024 and 2025. On the other hand, interest expenses have seen a significant increase of $12,021 from $62,433 in 2024 to $74,454 in 2025. This rise can be attributed to changes in interest rates and the composition of debt. Specifically, the interest rates on certain debt facilities have increased, such as the 2024 Series A senior notes and the 2025 Series B senior notes, which now carry interest rates of 6.56% and 6.33%, respectively. Overall, while the company's debt level has remained relatively stable, its interest expenses have seen a notable increase due to changes in interest rates and debt composition. The performance of various regions and segments has been a mixed bag over the past year. On the positive side, Richmond, Virginia has seen significant improvement with the acquisition of a large leased campus in January 2026. This move is expected to boost the region's economic growth and attract more businesses. In terms of stability, the U.S. government segment has maintained its high occupancy rate at 96.1% in 2025, a slight increase from 95.5% in 2024. This indicates that government agencies continue to rely heavily on leased spaces for their operations. However, not all regions have fared as well. State and local government segments have seen a decline in occupancy rates, dropping from 3.7% in 2024 to 6% in 2025. Meanwhile, non-governmental tenants have also struggled, with an occupancy rate of only 6.4% in 2025, still lower than the U.S. government segment. These decreases suggest that these segments may be experiencing economic challenges or changes in demand for leased spaces. The company has a history of paying dividends to its shareholders. This practice is evident throughout the extracted summaries, with multiple pages referencing dividend payments. On the other hand, there is no clear indication that the company has engaged in share buybacks or repurchases. Instead, it appears that cash reserves have been used for required distributions, such as issuing new shares. Concerns about inventory buildup and supply chain disruption are valid concerns for companies. The potential government shutdowns and changes in tenant agencies' missions can lead to inventory buildup due to reduced demand or inability to access necessary resources. Furthermore, material shortages caused by supply chain disruptions pose a significant threat to businesses. Uncertainty about future trading arrangements and the possibility of imposing or increasing tariffs on various products, raw materials, and intermediate goods exacerbate these concerns. These factors can disrupt the smooth flow of goods and services, leading to inventory buildup and potential losses for companies. That concludes the financial summary for Easterly Government Properties, Inc. Feel free to comment below, and I will be happy to answer them when possible.